I welcome all participants to it and thank the Department of Economics at Roma 3 for its organizational support. I would also like to thank INAPP Institute, the Italian Association of Labor Economists, the European Association of Evolutionary Political Economy for their sponsorship of the conference. And finally, I would like to thank Professor Guarascio and Professor Nikiforos for accepting our invitation to deliver the keynote speech and the final lecture of our conference, as well as Alessandro Borin of the Bank of Italy and Professors Gamberlini and Passarella, who will participate in the plenary session this afternoon. This year, the conference focuses on the impact of the current changes in the global economic and political environment on the labor market and income distribution. As is well known, in the 4 decades before these changes, a process of global trade and financial integration occurred that had a contradictory effect on growth and income distribution. A convergence between developed and developing countries was accompanied by polarization in income distribution due to the fragmentation of production processes across countries, the uneven sharings of profits across value chains, and the rules governing market access. In developed countries, inequality increased through lowering blue-collar employment opportunities and reducing the wages of unskilled workers compared to those of skilled workers. Moreover, larger firms in particular were able to increase their profits because of cheaper imports from abroad and at home, the weakness of workers in wage bargaining. However, the current return of tariffs and reaction against the multilateral trading system will probably not reverse these effects. The impact on employment in developed countries is uncertain due to the possible negative effect on the volume of international trade, which, however, has not materialized yet, their industrial structure and their position in the value chain. Moreover, cost increases will probably be passed on to domestic prices, and the great uncertainty characterizes the evolution of the international monetary system and exchange rates. These points will be discussed in the keynote speech, the final lecture, and the plenary session of our conference. They highlight the renewed importance of and need for domestic industrial policies, the defense of real wages in the face of inflationary pressures, and the capacity of industrial relations systems to adapt to trade and technological changes. They also highlight the need for Europe to have appropriate macroeconomic responses to global fragmentation, ensuring an enlargement of domestic markets, which would call for a change in the institutional setting of the European Union and in the monetary and fiscal policies followed in the last decades. Our 9th International Astril Conference has brought together several contributions in all these fields and other themes regarding the labor market and industrial relations on both theoretical and empirical grounds. We have received a large number of papers and have organized 1 plenary session, 3 special sessions, and 15 parallel sessions with a total of 79 presentations. They concern mainly the effects of structural changes in the labor market, macroeconomic issues related to open economies and the response to global fragmentation, the evolution of income distribution, and the reshaping of the welfare system and industrial relations. I must thank INAPP, the Italian Post-Keynesian Network, and the Labor Law Group for organizing a special session on some of these themes. I would also like to thank Federica Arena, Antonino Lofaro, Vincenzo Pistucci, and Giacomo Sbrenna for organizing our pre-conference held yesterday, in which we had several interesting presentations by young scholars and 2 lectures delivered by Professor Nikiforos of the University of Geneva and Professor Barbieri Goes of Piemonte Orientale University. That's all. I don't want to take any more time away. Before the speech of Professor Guarascio, I would like to briefly give the floor to Professor Costantini, head of our department, and Dr. Forlani, president of INAPP, for the welcome addresses to the conference.
Thank you very much, Sergio, and welcome to the Department of Economics here in Roma 3. It's a real pleasure to open this ninth edition of the conference. Means that it's a long-lasting story of our department to host this conference, and just listening to the news this morning, I was wondering if during this conference some interesting hints related to how to solve the international stack in which we are could emerge thanks to older and young scholars. So this is to say, we need such kind of events in which we discuss with a critical view the current situation from a geopolitical and economic point of view, and all of the issues and topics that were mentioned by Sergio seems to me that should be addressed together. So we need a complex framework, and a university environment is the best place where to collect such kind of differentiated aspects, point of views, methods, and also theories. It's a special gift to be here due to the fact that I see many old friends. And every year we are together, and this is something that is warming the heart, not only the mind, and also to see many PhD young scholars coming from all over the world that are here, meaning that despite we are not an orthodox department, we have still the power of gathering together younger generation, and I think that this is something to be. It's our legacy, and it's something to be, let's say, be emerged in these difficult times. So thank you all for being here and enjoy the conference.
So now Dr. Forlani, President of INAPP.
Buongiorno a tutti, grazie dell'invito. Sentitevi parlare in italiano per non mischiare il bergamasco con l'inglese, quindi grazie per l'invito e gli auguri di buon lavoro anche per la giornata, le sezioni che sono attese oggi e domani. E un ringraziamento particolare per la collaborazione pluriennale che si è sviluppata tra l'Università Roma 3, l'Astril e l'INAPP. L'INAPP è in una fase particolare del cambiamento della governance del mondo del lavoro in Italia, del Ministero del Lavoro in particolare, con lo scioglimento dell'ANPA, dell'Agenzia Nazionale del Lavoro, che riconduce al nostro istituto tutta l'attività di valutazione delle politiche. Questo è un tema assolutamente centrale, oggi molto focalizzato nel dibattito internazionale sul riposizionamento geopolitico, cioè l'influenza degli stati nell'ambito delle filiere produttive, come uscita da un percorso di globalizzazione che presenta grandi margini di incertezza e mobilita un'ingente mole di risorse in investimenti sul controllo delle tecnologie, sottovalutando uno dei grandi problemi, cioè l'impatto delle tecnologie. Le tecnologie hanno una componente distruttiva e una componente creativa. Dall'equilibrio tra innovazione tecnologica e innovazione sociale si possono ponderare la capacità di gestire i costi delle transizioni e i benefici in termini di produttività e di redistribuzione di opportunità e di reddito. Questo tipo di focalizzazione è ancora molto debole e incerto, mentre abbiamo una certezza, noi in Italia siamo un paese vecchio, Cioè dobbiamo affrontare queste dinamiche con una certezza, che nei prossimi anni avremo uno spostamento radicale delle generazioni che hanno retto lo sviluppo italiano, quelle baby boomer, nell'ambito delle persone a carico, e quindi con un problema di ricostruzione della politica e della popolazione attiva da un lato e della sostenibilità del sistema del welfare dall'altro, in particolare della quota delle persone non autosufficienti che aumenta in maniera vertiginosa con l'invecchiamento della popolazione, l'allungamento positivo. Quindi ripensare le politiche all'interno di questo fenomeno, tenendo conto degli aspetti certi, quelli demografici, e gli aspetti potenziali che possono avvenire, e rileggere la funzione delle politiche rispetto a questi fabbisogni, non con approcci teorici astratti, è il passaggio che dobbiamo fare. E l'impegno strategico che abbiamo messo in campo come INAPP, cioè quello di coniugare le due letture per orientare poi la crescita dei fabbisogni in relazione, l'analisi della crescita dei fabbisogni in relazione alla capacità di risposta, in termini di investimenti sulle risorse umane, in termini di inclusione, in termini di governance, cioè mobilitazione degli attori che siano funzionali a ottenere lo scopo, cioè quantità di innovazione sociale in grado di reggere la quantità e la potenza dell'innovazione tecnologica, riducendo le simmetrie. È lo sforzo che vogliamo fare, ma non siamo autosufficienti nel farlo. Richiede capacità di letture interdisciplinari, sensori complessi, e credo che, e chiudo dicendo, abbiamo una grandissima opportunità che possiamo cogliere insieme. Lo dico qua in un'università. È stato costituito in Italia l'osservatorio presso il Ministero del Lavoro per l'analisi dell'impatto delle nuove tecnologie nel mercato del lavoro e nel welfare, e viene affidata all'INAPP diciamo, la regia tecnica operativa dell'impianto, che per noi è una grandissima occasione per aprire anche i contributi, le vedute e il numero degli attori che possono concorrere a generare innovazione, recuperando ritardi storici del nostro paese italiano, cioè a partire da una popolazione attiva che è più debole. Abbiamo 8 punti in meno di tasso di occupazione, quindi circa 2.800.000 posti di lavoro in meno, che riflettono anche poi una distribuzione dei redditi familiari più problematica. E soprattutto abbiamo una capacità di produzione di competenze che non è adeguata. E paradossalmente una produzione di competenze che viene sottoutilizzata. Cioè sono i paradossi italiani che vanno ricondotti e riletti in termini di criticità, ma anche di opportunità, cioè della possibilità di poter fare dei balzi che non siamo stati capaci di fare nel passato, in termini di crescita della produttività, valorizzazione delle risorse umane e valorizzazione del risparmio nazionale. La nostra nazione non è una nazione che non ha risorse, è una nazione che sottoutilizza le risorse che ha. E quindi credo che questo sia il punto di partenza per un lavoro collettivo che abbia come obiettivo aumentare l'efficienza dell'azione politica e dell'innovazione sociale, per renderla coerente con quello che sta capitando in termini di innovazione, di potenza dell'innovazione tecnologica. Grazie e buon lavoro.
Thank you to Dr. Forlani, and now it's a pleasure to me to introduce Professor Guarascio. We all know him. He's professor at the University La Sapienza. He's external affiliate to INAPP and Sant'Anna School of Advanced Studies. And if I remember well, is also a member of the scientific committee of Fondazione Bronolini, and he wrote several contributions on structural changes and their impact on employment and income distribution. The title of Guarascio's speech is Quo Vadis Europe, Structural Change and Industrial Policy in the New Global Context. So the floor is yours.
Okay, so can you hear me? Yeah. So many thanks, Sergio, for your kind introduction. Yeah, I'm going to open that, hopefully. Okay. Anyone can help here? Perhaps Davide?
I don't know, David.
Great.
You
So,
help. I mean.
Yeah. So bene.
Provare a fare così.
Ah, prova con... No, non c'è Adobe.
Sì.
Prova il Chrome. Non c'è. Che lo apre online, però.
Sì, ma si è aperto. No, non abbiamo provato.
No. Questa è la presentazione. Devo capire come mettere la schermo intero, però, così, perché...
Uno di questi deve essere.
No. Per aprirla, non c'è modo di aprirla con la piccola, no? Ho tornato sul desktop.
Torniamo sul desktop. Cominciamo. Personalizza.
No, ma questo non c'entra niente. Cioè, sembra che non abbia proprio
Sì, pure a me.
e che non riesce ad andare sul desktop.
PDF. Vediamo se c'è.
No, che utilizzi ovviamente.
Proviamo a fare con sé.
Ok, però qua ci dovrebbe essere. Ok, so finally. So many thanks, Sergio, and many thanks, David, and all the organizers for your invitation. I'm pleased and honored to be here, also because I would say I'm an early supporter of Astril since its, I would say, very inception. And I think it is great to see that this conference is growing, and also that this is a kind of safe harbor for non-mainstream young economists in particular to present their work, discuss, build networks. This is something that we sorely need, and so I think that it's important that these kind of conferences keep growing and that perhaps spill over also in other places, giving further opportunities of this kind. So, as you can see, my presentation is a collection of works and of research activities that are at least 2-3 years long. Many colleagues and friends are involved in some of the things that I'm going to present you, including Francesco Crespi, who is here, but also many others like Anna Maria Simonazzi, with whom we started working on the long-term evolution of the European economy, its crisis, the core periphery divergence within it, and the impact of crisis on the whole fabric of the European economy. And what I will try to do is, in fact, to understand how Europe is doing and will be doing in this new scary global context, as has been anticipated, and the spoilers that not that well, and not only for the kind of disruptions that we are observing, but also for some dysfunctional characteristics of the European growth model and economic policy setup that now are coming even more violently to the fore, showing how vulnerable and let's say, in a difficult position Europe is in general, and in particular now that some more problematic developments are coming to the fore, as said. So, very briefly on the outline of my presentation, I will start just highlighting some of the major changes that we are facing and how these changes are, let's say, impacting on the very growth model that Europe has followed so far, and as I said, are unraveling also some further vulnerabilities that is very important to focus on, also to understand which policy prospects do we have in order to ameliorate the situation. Then I will move to the synthesis of a paper written with Anna Maria and other colleagues, where in fact we adopt a long-term perspective by showing how the current crisis has one merit, which is to highlighting very clearly the root causes of Europe's vulnerability on the one hand, giving us the opportunity to look through some of the consequences from a structural and structuralist point of view that we can also highlight, and then opening up the stage to enter into one of the major challenges that is still here, even if we are seeing a lot of step back, and in particular in the West about that, which is the green transition and how we, let's say, react to climate change and to the pressure of climate change. And this is a very, let's say, good case in point in order to analyze how Europe is shaped, what are the vulnerabilities, as I already mentioned, and how the new industrial policy, which is one of the novelties that is characterizing this phase, because of course there is a change also in the way economic policy is designed at the European level. And so the question is, to what extent such a change is a true change, and to what extent is likely to conduce Europe in a better place or with better tools to face this kind of problems. And to conclude with the set of selected evidence I would like to share with you, I would pinpoint something from two different research work that we are carrying out with Francesco Crespi, Enrico Marvati that has just arrived, and other colleagues, focusing on two crucial value chains, which are crucial in general. And in fact, as we are seeing, most of the trade and technological wars are also impacting on these supply chains. But of course, these are fundamental for the decarbonization trajectory, which is not only important for environmental reasons, but also, as we have seen, as a consequence of the Russia-Ukraine war, for, let's say, security and geopolitical reasons as well. And finally, hopefully with you, I would like to share some thoughts and some discussion about policy implications and prospects. I have chosen this picture because I think this epitomizes one of the major changes, one of the major blows to the so-called old order, because this is a blue collar, a metal worker, a manufacturing worker that, having beside him Donald Trump, is announcing with joy the tariffs that have been introduced by the US government on the Liberation Day last April. This is, if you like, a watershed moment, at least from a symbolic point of view, as compared to the previous order, where the endless globalization, the idea of the free movement of capital, goods, growing FDIs as the fundamental way to allocate resources, shape the division of labor, shape specialization, and also, of course, with huge consequences in terms of income distribution. But we heard the story of the "there is no alternative" mantra, and the "there is no alternative" mantra was a lot about external constraints related to an order where the free movement of capital and goods and the dominance of international institutions safeguarding this order was apparently the only game in town. And Europe was, and still is, unfortunately, because, I mean, we have some inertia that we are facing right now, an economy that based with a very strong kind of mercantilist and export-led growth model, exploiting this kind of setup, adopting a very peculiar kind of growth and economic policy setup with lots of damages and negative consequences, as we will see, but that apparently, until the game was going forward, was more or less doing well, at least for Germany, for German exporters and some specific capitalistic interests in Europe. Now we are seeing what the price of such a misguided strategy is. In the background, we have also to acknowledge some political economy elements, some contextual elements, which, however, we cannot neglect, because otherwise we reason about the European economic policy strategy, neglecting the fact that power on technology, on raw materials, on the financial system is very much polarized and asymmetrically shaped, with a weaponized interdependence, so using choke points and relevant, let's say, points within the global economic system in coercive ways to threaten other economies, to blackmail other economies, and in fact putting those which have vulnerabilities in an even worse condition. And so the background is an old hegemon that is gradually declining, of course at a cost, as we are seeing every day with more dangerous developments in front of our very eyes, and the new one with huge technological, economic, and also military capabilities standing out. We don't know how long and with which kind of consequences this process will go on, but this is for sure in the background what we are witnessing. And so there are also relevant phenomena that we should underline within this context, like multiple systemic crises that, as non-neoclassical economists, we know are not exogenous phenomena, but are endogenous to the kind of growth model and development model that we have followed, or in general, the shape of the capitalistic system in the moment or in the phase we are observing it. And so the financial crisis in 2008, we have Antonella and the other colleagues that have studied all these things, producing lots of contribution, explaining the root causes and the structural implication of this phenomena, the COVID crisis with all this distributive implication, the Russia-Ukraine war. And then we have also phenomena that have direct impact on the things that we are mentioning. So trade wars, the tariffs I already spoken about, weaponized interdependence. There is an interesting literature on this that I think is useful also for economists. Lots of uncertainty that, of course, as we know, has an impact on investment, so on GDP dynamics, and then, of course, in terms of distribution. There are huge shockwaves also in the financial system. There is the problem of the dollar, so to say, and relatedly of the digital currencies that have been brought about. But of course, the role of the dollar that is challenged, even there, we don't know how fast and what will happen. And the problem of the US public debt, that perhaps is something that is intertwined also with the development that we are observing from a political point of view. This is a graph taken from World Bank data and from a recent report by the Centro Economia Digitale. That is, again, another interesting way to set the stage, if you like, because there is a huge debate. I mean, Richard Baldwin and many other international economists arguing, are we witnessing the stop of globalization, a globalization, a regionalization dynamics? For sure, we are observing a process of fragmentation, of further fragmentation, and of partially regionalization. If two blocks building their own areas of influence, so to say, using an old jargon, are standing out, then it is also physiological that from a trade and production networks point of view, things are changing in this respect. So let me enter into the first part of the presentation. In this paper with Anna Maria, Jelena, and other colleagues, what we do is basically this thing. We acknowledge the major change. In this case, this paper has been written in 2022, 2023, but still started written. But still, I mean, the process was already very clearly ongoing. And so our idea was that the kind of change and the disruption at the global level had the merit to highlight what we call the long-run causes of Europe's structural vulnerability. And this can be also seen by looking at some very, let's say, key indicators, like, for example, the fact that on average, the macroeconomic performance of Europe has been always below that of its major counterparts, namely US and China, that core periphery divides have been a peculiar characteristic of the European growth model and long-term dynamics since the build-up of the common market, basically, of course, accelerating after the 2008 crisis. But this has huge structural implication, because this means that important areas of the European economy weakened, partly deindustrialized, reduced their technological capabilities, and as we will see, in general, we had a biased development trajectory, also related to the main sector that has driven the evolution of the European economy, producing damages from a technological and structural point of view. And in fact, even Draghi, who has the responsibility on most of the things went badly in the last 20 years, at some point, writing the report commissioned by Ursula von der Leyen, realized that perhaps we killed demand and we perhaps better didn't do this, that there were some dysfunctionalities, and in particular that we are lagging behind in crucial domains technologically and from a productive point of view, and that, surprise, surprise, this can be a problem, in particular in a context like the one that I have just described. Other elements, you will see this also empirically stemming from the papers that we have written, import dependency on the one hand, so no longer able to produce lots of important intermediate goods and components, lagging behind in many crucial technologies like digital ones, but also green ones that we need to import. And this, as we will see at the end, opens up important policy conundrums. But we are also a problem of depending too much on exports as a component of demand, and this could be problematic as well, in particular when you are driven by the myopic short-term profits needs of multinational exporters that identify China as their major outlet after 2008. They believe that the Chinese market would grow and receive their goods without an end, but at a certain point, what happens is that Chinese companies become more competitive than the German ones in key sectors, that trade shocks reduce the scope to filling the world with German goods, and so problems come about, as we are seeing with the close to be recession in Germany, also from a macroeconomic viewpoint. Of course, these changes cannot leave completely the economic policy setup unchanged, even if, I mean, Brussels and Europe in general is a very interesting case study in terms of diabolicum perseverare, so to say. But yet, we have seen at least the discovery of industrial policy, the idea that it could be allowed to select sectors, to select technologies, and intervene in order to strengthen the technological capabilities accordingly. And so, Next Generation EU, as a response to the COVID crisis, Repower EU, the CHIPS Act, something close to the old-style industrial policy where the state has a responsibility, which can plan something, which can decide something which was completely out of the table until 4 or 5 years ago in Brussels, and that now is coming back to the fore. We will discuss whether this is a true comeback, how and with which implication. Very quickly, because most of you are well aware better than me about these things. However, we thought that in this paper, Giacomo, who has just entered, is one of the co-authors of it, we thought that this was really a good case to highlight the root causes and put them in a systematic way, one beside another. So first of all, the European growth model has been fundamentally shaped by the German mercantilistic approach, so to say, and by the dominance of the German exporting sector, at least for a consistent amount of time. But this had important consequences, because in order to ensure competitiveness to exporting firms, you need to contain costs, and so wage moderation and in general austerity policy, slashing demand, slashing in particular public expenditure has been a fundamental characteristic of the growth model, as we know, and as heterodox economies, we know that this has long-run consequences in terms of productivity, technological capabilities, and competitiveness. As I said, the unbalanced development characterizing the European economy, again, is a trait which contributed, of course, not immediately, but over time, in weakening technological and productive capabilities in certain areas in particular, but then affecting the overall European economy. Of course, southern periphery, Italy in particular, has been one of the most affected. And then the illusion of exploiting the German market after 2000, the Chinese market, as a way to restore growth prospects is now in front of our very eyes. And just to mention some very let's say, quick elements of theory that here are very well known, having a growth model which systematically represses demand means killing some fundamental engines of productivity and so of growth more in general, also of innovation. So there is no need to mention Caldor, Pasinetti, Silos Labini, in saying that basically Europe has autonomously ballasted its own economy and development part. I already mentioned the unbalanced development and the core periphery divides. What is important also to acknowledge, and this, if you like, is the combination of a structuralist perspective with a political economy one, having an economy where you have a dominance of a specific group of firms and sectors which are localized in Germany and in the set of Visegrad economies that are connected to its core, manufacturing core, means also biasing the specialization, the technological development. And so what happened is that investment, R&D, also infrastructural decision, and also energy policy decision have been significantly shaped. Brussels is the place where the lobbies have, let's say, their place to be in order to try to shape policies. And I mean, German manufacturers and exporters have been among those more capable of affecting policy making according to their own needs. And this had a huge impact on industrial and energy policy too. And now we are paying the price in a way that also Draghi is acknowledging, as we have already said. And then, of course, the counterpart of all this is the economic policy setup. Because the economic policy setup, I know this could be boring to a certain extent, but I think it is also important to set well the stage before discussing about what can happen and how to design policy and what is still going so wrong right now. Well, a procyclical fiscal framework is what we still have now if we look at how fiscal rules have been changed, namely reducing the scope for public expenditure and public investment, but more dangerously slashing demand and public demand in particular in areas where it is most needed, with the same mechanism that penalized the periphery throughout the last 25 years. Industrial policy until 5 years ago was all about horizontal policies, incentives, let the market operate freely, and any kind of direct and selective intervention considered to be inefficient and to be ruled out. This, of course, has been a tragedy as we were facing countries, in particular like China, but to a certain extent also like the US, which were doing just the opposite in order to try strengthening specific industries and supply chains. And also trade and competition policies that to a certain extent substituted industrial policy in Europe favored polarization and the strengthening of few firms, few industries in specific areas at the detriment of all the others, without thinking with a long-term perspective and in strengthening the overall economy. So we can now go through what we define the consequences, or let's say the empirical counterparts of some of the developments that I have mentioned, and I will go through them as we list them in the review of Keynesian economics paper that I mentioned before. Because what we show, first of all, focusing on demand, following also some interesting scholars like German who studied how the role of German exporters in shaping the evolution of the European economy has biased both the supply and the demand side, introducing a number of, in some cases, neglected risks. So here we see how, in fact, exports towards the Chinese market became more and more important for the German economy starting around the 2008-2010. Don't forget that this means also, due to the kind of agreement and joint ventures that companies like Siemens or Volkswagen have established there, a transfer of a lot of knowledge and technology. It's not by chance that BYD is now the largest seller of electric cars around the world. And the graph on the right-hand side just shows that exports towards China went above those towards the US. Here we are looking also only at German data throughout sectors, so also in high technology sectors. And this as another counterpart, because if we use input-output data and if we account for the value added activated by €1 of exports, we can see that over 20 years, more or less, the share of value added activated abroad by European exports has increased substantially and in a constant way. And we can see this also if we look at more rough figures like the ones related to the share of imported intermediate inputs. So what we can see is that the importance of imported intermediate inputs within the production process of European industries and firms grew constantly over time, and that using the revised Pavis taxonomy, we can also appreciate the fact that European firms and industry kept importing more and more medium and high technology imported intermediate inputs, meaning that the technological and knowledge-related leadership is starting to move away, if you like, a proxy of the gradual impoverishment of the European economy as a whole. If we look at technology-related data, these are patents, both in the ICT and the semiconductor domains, which are, of course, crucial domains for the digital industry to produce any kind of digital goods. I'm talking about semiconductors. As you can see, we have, of course, that we can appreciate a relative stagnation of the intensity in patenting in Europe, but of course, we are also witnessing the rise of China, and that China now, yesterday, I received a paper published on Nature showing how China is now dominating the production of knowledge, of frontier knowledge in the artificial intelligence domain. When it comes to green technologies, these are the same OECD patent data. The picture is a little bit more mixed because Europe has still the legacy of some strength from a technological and knowledge-related point of view. So, for example, when it comes to energy generators or to wind technologies, we know, for example, Denmark being one of the leaders in the wind industry. Europe is still doing quite well. Of course, this is not the case of other two fundamental industries, but I will come with more detail on this, which are the solar and the lithium battery ones. So this opens the stage to the second part of my presentation. This will build on a paper just published on governance written with Anna Maria Simonazzi and Jelena Relic. The title is United in Diversity with a question mark, and basically what we look at is how a vulnerable and divided Europe, like the one that I've just described, confronts the green transition, the green industrial policy, and in general the green strategy that Europe has adopted, in particular posing very ambitious targets. Now we don't know what will happen to these targets given the political and international developments, yet climate change is still here. Renewables could be one of the way out of dependency on fossil fuel with its huge geopolitical implications, as we know. So we thought that focusing on this particular challenge and domain was a very good test bed to further investigate the positioning and the structural situation of the European economy, digging into one of our, let's say, core elements of interest, which is internal divides. Because the question is, to what extent, let's assume that we will keep accelerating the path towards the green transition, we will keep with our targets, and we will still invest on green industrial policy as designed by the European Commission. Will this deepen the divides, promote convergence, lead to downward convergence, meaning the once core countries like Germany risk going down, so producing convergence, but towards the worst, not those in bad shape going upwards. And so let me set the stage on this. First of all, we have to acknowledge that the ability to pursue the green targets, the net zero targets that I mentioned, is challenged by some of the same problems that I mentioned before, so the technological backwardness and the dysfunctionality of the growth model that are all still here, but we have also specific problems like access to key raw material, to critical raw materials that are needed for the green transition. The fact that now technological capabilities and knowledge is mostly concentrated in Asia, and this poses obvious challenges, and the fact that now we have the changes that I mentioned that are also producing dangerous development, like the turn towards militarization that may risk taking away resources not only from the welfare state. We read these brilliant articles on the Financial Times that we need to renounce the welfare state to build a workforce state and this kind of things, but of course also the green transition could be one victim of this potential development. And then there is a policy conundrum. Again, more specifically, we are working with Francesco and other colleagues on this specific issue between the need to accelerate the transition, so to be loyal to the targets that I have just mentioned, and the risk entailed in the growing import of foreign technologies and inputs, so stimulating the growth of those who are already stronger. And this, of course, can clash with objectives, because this will mean that when you put forth an industrial policy program, if most of the components and technologies are produced elsewhere, the multiplicator and the macroeconomic and employment impact could be small. And on the other end, we have brown sectors, very important, also in Italy, that at some point will be faced by the costs of the transition. And so this is something that needs to be properly discussed, faced, and analyzed. And so empirically, not only with this work, but with further work that are about to come, we try to, let's say, focus on this very specific question also with data and with a model. What we do in the paper with Anna Maria and Jelena is trying to address this research question. So can the return of industrial policy and green industrial policy in particular they bring together the two objectives, so accelerating the green transition and avoiding further divergence internally, or better, restoring convergence? So in order to try answering this question, first of all, we map EU member states according to very relevant variables that can tell us how are they shaped and positioned in terms of restructuring costs, so the costs of the green transition, and also resilience, so the tools and in general the elements that are needed to, let's say, favor a sustainable transition and in general to accelerate it in a feasible way. And on top of that, discussing the new green industrial policy to see whether this is up to the task given the mapping that I will show you. What are the variables? Let me go fast, otherwise I will run out of time. I will show you a mapping of the EU member states based on two major elements: the share of energy intensive industries plus automotive, that we think in terms of employment, that we think is a good proxy of the expected restructuring costs that member states are going to face. On the other end, counterbalancing elements, so share of renewables in the energy mix, relative technological specialization in green technologies, and state aid, but the specific state aid for green projects as a proxy of stance for intervening and political commitment for the green transition. So I'm sorry because I fear you won't see anything here. I will try to tell you what this graph is about. So on the y-axis, you have the share of employment in energy-intensive industries. On the x-axis, you have renewables in total available energy. And what we see is a kind of new divide emerging, because the countries like the German manufacturing core, but also Italy, expected to face the highest restructuring cost, having the largest amount of employees. I mean, in Germany now, I don't remember, but we're talking about millions of workers, of course, in the energy intensive and brown, so-called brown industry. However, they are very lagging behind in terms of usage of renewable energy. So we have the Scandinavian country where the expected restructuring costs are very small, which are far beyond in terms of the renewable targets, but they need it less, so to say, while in the countries where we expect more problems in terms of restructuring cost, this is not the case. When it comes to the relationship between the same indicators, so employment in energy-intensive industry and specialization in green technologies, things change a little bit, because some of the countries of the German manufacturing core, including, of course, Austria and Germany, are quite well shaped, together with Scandinavian and Nordic countries. The problem is that some of the Eastern European countries, and in particular the Southern periphery, are not in the same conditions. So we are in a situation where you have poor technology, high expected restructuring cost, and not so fast deployment and usage of renewables. An even dire picture comes about if we look at green-related state aid correlated with the indicator that I mentioned before. Because again, what we see is that the periphery, with the problems that we all know, in particular given the economic policy setup and the fiscal setup that still characterizes Europe, has a smaller room for intervention. And so the amount of resources that so far Germany, among all the others, have devoted to support firms also in their process of green restructuring is way higher as compared, for example, to the resources that the Italian government had at hand. And this is a big problem, because still much of the so-called industrial policy in Europe is left to the resources and efforts of national member states. And this is a pity, as it is clear to all of us. Very quickly, we added to the variables that I have just mentioned other important dimensions, like asset finance in solar and wind, public research and development in renewable energy, again, state aid for environmental protection, but also public debt and an indicator of energy import vulnerability. So how much energy member states import, and to what extent they're importing this energy from a very strong supplier in terms of their market power. So an index not only of import dependency, but also of import dependency cum vulnerability, if you like. And again, we are showing a new kind of divide that can be taken home by, if you give credit, of course, to the exercise that we have done with this cluster analysis, because we have the green leaders that are of course in the Nordic and Scandinavian area of member states. We have the German manufacturing core with this ambiguous positioning that I mentioned before, so not so well shaped in terms of expected cost and deployment of renewables, but with quite good technological situation and with quite some room to intervene, at least concerning the fiscal pace of the state. Then, of course, if Germany decides to spend everything to buy tanks, missiles, most of them with American digital components, perhaps things will be further worsened. But still, we are discussing as we were 2 years ago, so to say. And then there are the green stragglers. we are included there, and of course the green stragglers are those in a worse situation for the reasons I explained, and the group of smaller countries that we call the emerging green adopters, which have a smaller share of energy-intensive industry employment in energy-intensive industry, a rather good deployment of renewables, and a situation in terms of public debt and public resources that is not so bad as the one of the European periphery, and so these are likely to they are not in a so bad position. Let me skip this because I think I more or less commented the results already. So the paper concludes with an assessment, quite comprehensive assessment of what we can define the new green industrial policy of the European Union. So first of all, we have systematized and listed, also describing all the characteristics, the European green industrial policy that, as you can see, are not only distinguished in terms of true or fake funds that are allocated to each of those measures, because the problem in Europe is that every week we have Ursula von der Leyen announcing a new transformative, huge policy. Then we discovered that there is 1 billion euro for 5 years, and the rest we hope private capital or national resources doing something, or regulation sold as industrial policy intervention or things of this kind. So we have many instruments here. But as you can see, we had to include also due to the referees, Horizon Europe, the RRF, which of course have components which are important also to build knowledge base and technological capabilities in the green domain. But let's say the true industrial policy measures here are basically known except to the Recovery and Resilience Facility, which of course is a temporary measure, as we all know, the Innovation Fund, which however has a very poor allocation for a 5-year period onwards, and the Just Transition Fund, which is a component of the cohesion funds, so to say, which is even smaller. Let's say that the most important bulk of resources and of interventions is left to state aid and important European projects, which are a way of coordinating efforts, but still resources coming from nation states. And so the exercise here, again, you can see anything, but the paper can be, I think, freely downloaded. Basically, we use the clustering that I shown before. So green leader, green stragglers, emerging green adopters, and German manufacturing cord. And we try to map the number of interventions for each policy that I mentioned before by cluster. And the result is that the appropriate correlation that we would have seen, meaning more interventions and more structural intervention when it is more needed. So green stragglers, first of all, emerging green adopters, and then the rest is not respected at all, because most of the resources and the interventions are concentrated in the German manufacturing core and to a certain extent among the green leaders. But the most concerning thing is that in terms of size, state aid, so national resources, and the Recovery and Resilience Fund that in 2 years will be gone, is the most important component. So if this is a very rough but still systematized attempt to assess and to evaluate green industrial policy efforts, given the broad and also the member state specific situation, let's say we are not in a very good moment, so to say. So very quickly, because I think I have 10 minutes. Okay, 5 minutes. Okay, so let me show you. Okay, I will jump the part on solar panels. Again, I work with Francesco, Giacomo, Serenella, and other, and that's it. Just to show you that if we look at the solar supply chain, what we see is that in 2 key components, so the midstream and the downstream, Europe is now dramatically in deficit, so imports more than what it exports, and more concerning because there you can see it, but we have the share of the main suppliers providing solar components to Europe. We are mostly dependent on China because it has the lion's share of the shares. And okay, I mean, I will jump on this. We can also see, because in the paper, both these as well as and I will show you few figures from the one on batteries, and what you can see is that not only from an import and production point of view, but also from a technological point of view, we have that China is growing tremendously, and we are stagnating, if not going backward with respect to a technological strength that we used to have at the beginning of the period, so early 2000s. And this is an important outcome of the analysis that we are replicating in the battery paper, because this is an intelligence kind of a supply chain intelligence approach, which allow us to identify specific products and area where we have both a strong import dependency on very powerful supplier, and we are also poor in terms of technological capabilities, which can be the areas or some of the areas which are in a more dangerous situation, and so where probably industrial innovation policy is more sorely needed. Here on the left you have Europe, and on the left you have China. Basically, what you take home from these graphs is that a relevant amount of the crucial products in the European case are in the dangerous part of the graph, because we have high dependency and poor technological capabilities, while the opposite is true for China, which has most of the supply chain in the other part of the supply chain. Let me show you just this one, and then go all to the parallel session where Nicolò Geri is going to present the paper, because he's one of the co-authors, and he's going to present in detail this paper. Basically, this is the same logic, because what we are seeing here is on the y-axis, the import dependency indicator weighted for the strength of the supplier, and on the x-axis, the revealed technological advantages, working in a very detailed way on trade and on patent level data in a super granular way. So really here we are tracing in a very detailed way the dynamics of the supply chain. And what you can see is that the long run trajectories 2002, 2022 show us how hierarchies globally have reshuffled in a dramatic way, because you have that Europe starting and the US starting from a place where technological capabilities were not so strong, or better specialization in battery related technologies were not so strong, remain more or less where they were, but they jumped in the area where the dependency situation, so the vulnerability in terms of production and trade relationship, is very concerning. On the other end, the purple line and the purple arrow is the Chinese one, and so China moves from a situation of close to the median of the dependency indicator and relatively low technological specialization to a situation where there is no dependency at all and a growing technological specialization. So let me go to the final slide in saying that let's say the changing global order is posing new threats and lots of challenges, apart from what we have discussed about Europe, but for sure it is also highlighting, again, many of us have studied and written about these things in the last 10 years, but if you like, these are even more concerning and dangerous now, because some of the drivers of growth that in a biased and unbalanced way, however, allowed Europe to grow, in particular some countries and sectors, are now running out of steam. And so contradictions are even more violent, and we don't know really what kind of policy strategy could, let's say, be well suited in a context of this kind. For sure, we know that some policy decision, in particular the one on militarization and arms, should be discussed, being very well aware about this context, and of course of many other things that we didn't have the time to discuss, but that of course are part of the discussion. Sorry for being so long, and I will be happy to discuss with you.
you for your very interesting presentation. So, I mean, we have 5 minutes for some questions from the floor. If
May I borrow your pen or a pen? Thank you.
No. Okay, that is what. Yeah, thank you for the presentation, which is quite stimulating. Summarize, I think that the basic issue is, in my vision, political, no? Because we have a lack of European vision, a lack of, let's say, common sentiment, common destiny sentiment, and this is what clearly explained by your historical presentation, which means also a lack of a significant European fiscal budget, which is the core of your analysis. But I think at the same time, there is one important issue which is coming from the financial sector. And I don't know whether you had the opportunity to analyze in more detail this issue, that is the lack of significant venture capital. And if you compare this with the US condition, then you have a clear and significant gap. So did you have the opportunity to, say, analyze in more detail this issue and, maybe suggest possible policy in order to stimulate this, component, which of course is quite crucial, for example, for startups?
thank you. So, some questions, other questions from the floor? No? Oh, yes.
Thank you, Dario, for your presentation, as always, rich, well-grounded, and with the contribution of your wonderful team of research. I'd like to underline that you introduced a word at the beginning. It was power. European Union has not, just discovered that the European Union has not a power on defense, on energy, on critical raw material, and so on. But we have spent the last 2 decades to criticize the only domain in which Europe has power, which is the single currency and exchange rate markets.
Okay.
I wonder if we agree now.
Okay, thank you. So
very quickly, many thanks. I mean, this is a crucial point. We didn't investigate this into much detail, but of course, it's crucial. Well, let me say, of course, there are historical reasons why the financial sector is completely different in the US, in the Anglo-Saxon world, if you like, as compared to the European one. Then there is also a structural reasons. I mean, we killed demand. So I think that capital goes also where there is demand in markets. And so it is meaningful to invest and to give money to firms that perhaps can do something also in that area. And on this, I will add that even American capital, so BlackRock, Vanguard, and also venture capital, are present in many European companies, for example, in those producing arms like Leonardo, Thales, Rheinmetall, and of course, many others. So the problem is that if you create demand in saying that you building institutions having a strong demand coming from the public sector in the first place, also then from the private one. That explains you why you have a Silicon Valley in the US, and we have Fraunhofer. We are happy about the university industry linkages in Germany, but of course this means that we have no digital sector, and that now we are realizing that if tomorrow Microsoft or Google turns off our emails, we need to send letters one to another within our universities. I mean, this is the reality, so to say. And it is not with incentives to venture capital that we can cure this kind of problems. But I'm not saying that this is not an important issue. It's crucial, but needs to be framed in this context, I think. And Max, on the euro. Yes, but the problem is that it is not by accident that we built a component, the monetary one, in a misguided way and producing more damages than benefits, and not all the rest of the economic policy and structural architecture. Because having only this and constraining the fiscal stance of member states and all these functionalities that we discussed has been instrumental for very specific capitalistic interests, not only German ones. I mean, Italian banks during the golden age of the low interest rates in 2004, 2005, 2006 were all happy of opening up new branches in Slovakia, in Hungary, in the Czech Republic, doing lots of profits, not for the Italian economy, but for those having Unicredit or Intesa stocks who are very rich. I'm happy for them, but I mean, then the European economy and the working class people is another thing. I mean.
Thank you again. And so now we have the coffee break, and then we start again the conference.